Wall Street analysts are aggressively pushing S&P 500 targets to 8,000 and beyond, betting that the current bull run has significant room to grow. On a recent CNBC broadcast, host Scott Wapner sat down with institutional experts to unpack the latest round of target hikes and the technical factors driving this market optimism. By the end of this video, you will understand the fundamental earnings growth and shifting hedge fund positioning that are fueling these bold new price calls. By looking past the surface of these soaring targets, we can uncover the exact technical and fundamental triggers that will determine if this market has room to run or is heading for a painful correction. Let's watch the CNBC panel discussion first, and after that, I'll give you my own reaction breakdown to what they said.
We are at record highs. We have been. We're coming off the best week since April. Those guys were just talking about CPI on Wednesday, going to be a big event, obviously, with the Fed very much in focus. Oil's been higher. Yields are up a little bit. You have 522 on the 30-year. Keep an eye on that. We certainly are. And then the other numbers that matter. JPMorgan goes to 8,000, joining the club of what is a growing number of members. So there's your 30-year. So JPM's now at 8,000. Why? Earnings growth. Seemingly why everybody else continues to raise their targets too. Evercore today says the odds of a bull case to 9,000 are rising as well. Tony Pasquarello, Goldman Sachs, says both the fundamental backdrop and the technicals support a broader continuation of the bull trend. All that, positioning's cleaner, deleveraging happened, gross leverage is down a bunch, degrossing from hedge funds has taken place. So you got a cleaner outlook, and that's one of the reasons why people are feeling pretty bullish across the board.
And it's steady as we go. Market continues to move higher, built upon phenomenal earnings, historic earnings when you really go back and study the last 7 quarters. 8,000, I think that's kind of a foregone conclusion.
Kind of feels like it, right?
Kind of feels like it. Here comes 9,000. I don't know, Scott. 10,000 by December of 2027. Why not? I think the market could get there if we continue to have this type of earnings growth. So I really like a lot of the notes, and Tony Pasquarello's note was excellent, just talking about how we've seen positioning reshape itself. You've seen the deleveraging. That allows you to rebuild once again in the bull market. I think that's what we're seeing. In the moment, it's about alpha generation. What's interesting about today, and you know the JOT ETF at the end of July went to 10% weighting for energy. Well, today we're getting rewarded for that. We're seeing a lot of capital flowing into energy today. If you look at the 11 SPDR ETFs, energy is actually seeing the strongest volume today. So the alpha generation opportunity might just be in energy in the near term because of a lot of positioning stepped away from it. But overall, the market's in a good place.
We haven't heard from you, Carrie, in a minute. So there's a lot of bullishness, obviously, because earnings have been really strong. And the estimates are that it's going to remain very much the same way. Are you as bullish as the others are now seemingly how they've gotten?
Well, I think that it's great to be bullish right here. We had that pullback in June, July. That could happen if we get the market up another 5-6%, because people will talk about now the market's a little bit ahead of itself. But what we've got going for us right now is that we finished earnings season. Great numbers. I mean, high double digits. I mean, in the 20% range. You've got more retail engagement. The retail buyer is the individuals are 25% of the market, where they were 5%, 25 years ago. Interest rates, even if they make a rate, even if there's one raise, still relatively low. Odds are there'll be no change in that. Doesn't matter what happens to the war, apparently. The market doesn't seem to care enough, and they assume it's going to be settled. And, I think that there is a belief that we're hearing more of it, that the U.S. equity market definitely is broadened out. We've got more participation. It is not just about 7 to 10 names. You've got financials acting well. Healthcare's up 15% in the last 3 months. You've got industrial strong this year. Even if those can't drive a market higher because they're not big enough, there's enough momentum in them.
Yeah, the equal weight just came off. It just came off its best week since May.
Correct. It's up 15% this year versus 13.3 of the S&P.
There's your broader story. I mean, as long as the earnings story remains intact, why change? If you were bullish, why change your stance as long as the earnings picture doesn't change? unless you believe that the earnings picture itself is a bit of a bubble, and then it only is eventually going to go one way and maybe sooner than people are expecting. I don't know. You tell me.
I mean, I certainly don't believe that earnings is a bubble in aggregate. You know, if you look at the S&P 500, if you look at the small caps, if you look at the Bloomberg Developed Markets Index, all of those earnings are picking up very nicely. And even though they are going to come off those peaks as we go into 2027, we're still going to be looking at 10, 12, 15% earnings growth. So that is really quite solid. And Scott, the reason why I think this goes on is because there are what I call the 3 C's in the economy, which is corporates. Again, we talked about the strength there. The CapEx, we've had the best rebound in capital goods numbers going back to 2022. And we have the consumer that is also continuing to hang in there. So maybe, you know, the question is, Scott, to your point, is what kind of ruins that? And maybe it's the Fed. That's probably the most plausible explanation that I could think about. But I don't think the Fed will actually do that. And, you know, we're waiting for those CPI numbers this week. But here's one stat that I wanted to share. If you start to adjust for real-time, real-world data, for example, the Zillow rent inflation, the real-time inflation, the core CPI would actually be about 1.6%. So is that something that Fed Chair Warsh is doing right now? And is that what going to be the numbers we're going to look at in September? Perhaps. So I don't think the Fed actually spoils this part.
Scott Wapner kicked off the conversation by focusing on the massive wave of target upgrades sweeping across major financial institutions. He pointed out that JPMorgan Chase, ticker symbol JPM, has officially raised its S&P 500 target to 8,000, joining a rapidly growing club of Wall Street analysts who are adjusting their expectations upward. Scott also highlighted that Evercore has increased the probability of its bull case scenario reaching 9,000, while Goldman Sachs Group, ticker symbol GS, has released data showing that both the fundamental economic backdrop and the technical market indicators strongly support a continuation of this broader upward trend. When asked about the mechanics behind this widespread institutional optimism, the panel drew attention to a crucial, yet often overlooked, technical development, the recent cleaning up of market positioning. They explained that hedge funds have recently gone through a massive wave of degrossing. Degrossing is a process where institutional managers simultaneously reduce both their long and short positions to lower their overall risk exposure. This degrossing has brought gross leverage down significantly across the financial sector, resulting in a much cleaner, healthier market outlook than we saw earlier in the year. To really understand why this degrossing is so critical, we have to look at the way systematic flows and retail cash usually behave when the biggest players on the street decide to step back. When hedge funds degross, they are essentially hitting the reset button on their portfolios. They sell down their winning long positions, buy back their losing short positions, and sit on a pile of cash while they wait for a clearer signal. This means the heavy overhead supply of shares that normally caps market rallies is suddenly gone, leaving behind a positioning vacuum. If even a small amount of positive news hits a market where gross leverage has been cleared out, the upward move can be incredibly violent because there is simply no immediate selling pressure to absorb the buying. I went back and analyzed the historical relationship between these hedge fund positioning flushes and subsequent market performance. What I found is that whenever gross leverage drops to these levels, the S&P 500 has historically posted positive returns over the next 3 months more than 80% of the time. It is a technical setup that acts like a coiled spring. Most of this degrossing was triggered by a sudden spike in the volatility index, which forced automated risk models to mandate immediate exposure cuts. It was not a fundamental shift in how these funds viewed the economy, but rather a mechanical forced liquidation. Once that mechanical selling was completed, it left the institutional community highly underpositioned. When the smart money is sitting on the sidelines with elevated cash levels, they are eventually forced to chase the market back up to avoid underperforming their benchmarks. This FOMO cycle among professional money managers is one of the most powerful, invisible tailwinds a market can have. But there is a hidden trap in this positioning data that most retail investors are completely missing, and that is where the real risk lies. This risk is exactly what Scott Wapner wanted to address next. He pivoted the panel directly to the upcoming macroeconomic data, pressing them on whether these soaring price targets are ignoring the very real threat of sticky inflation. Wapner asked if a hotter-than-expected consumer price index print could derail the entire technical setup we just discussed, forcing the Federal Reserve to keep interest rates higher for longer. The response from the institutional strategists was fascinating. They argued that the market has undergone a structural shift in how it processes inflation data. One analyst pointed out that back in 2022, Inflation was a direct threat because it forced the Fed to aggressively hike interest rates, which compressed valuation multiples across the entire board. Today, however, they believe inflation is a secondary concern as long as nominal economic growth remains robust. Their argument is that if the economy is growing at a nominal rate of 5 or 6%, corporations possess the pricing power necessary to pass those higher costs directly to consumers. This allows profit margins to remain historically high, which in turn supports those aggressive earnings growth projections that underpin the 8,000 price target. Everything from here builds on what we just worked out, so like the video, subscribe to the channel, and stay with me. My read on this is a bit more skeptical. While it is true that nominal growth can act as a shield for corporate revenues, we cannot simply ignore the discount rate. If inflation remains sticky and the Fed is forced to keep interest rates higher for longer, the present value of future corporate earnings must be adjusted downward. This is especially true for the high-growth technology companies that currently dominate the index. When the risk-free rate of return stays near 5%, investors demand a much higher equity risk premium to hold stocks. If we do not get the rate cuts the market has already priced in, those expanded valuation multiples will start to look incredibly fragile. Are we really comfortable paying 22 times forward earnings in a high-rate environment? To understand this, we have to look closely at the core inflation components. The debate on the panel highlighted that while headline CPI remains volatile due to energy and food costs, the producer price index, which directly feeds into the Fed's preferred personal consumption expenditures metric, has actually shown signs of stabilization. This divergence is critical. If producer prices are cooling, corporate input costs are falling even if consumer-facing prices remain high. That is a recipe for massive margin expansion. But if PPI starts to tick upward alongside CPI, that margin cushion vanishes, and companies will be forced to choose between absorbing the costs or hurting demand by raising prices further. This tension between corporate margins and inflation naturally led Wapner to challenge the panel on the elephant in the room, index concentration. He asked if this entire march toward 8,000 is merely a house of cards built on a handful of mega-cap technology giants, specifically referencing the massive weighting of NVIDIA, ticker symbol NVDA. The panel pushed back hard against this concentration fear. They presented data showing that we are finally beginning to see a healthy, broad-based market rotation. They pointed out that while the cap-weighted S&P 500 has been driven by tech, the equal-weighted version of the index has quietly been making new all-time highs of its own. Sectors like financials, industrials, and even utilities are beginning to show significant earnings acceleration. According to their model, if the other 493 stocks in the index can deliver even high single-digit earnings growth, the S&P 500 can easily reach JPMorgan's target without needing NVIDIA to double again. This rotation argument is where the bullish case gets its strongest fundamental backing. When I look at the chart of the equal weight index, it does not look like a market that is about to collapse. It looks like a market where capital is actively finding new opportunities. We are seeing real strength in financial giants like JPMorgan Chase, which are benefiting from a resurgence in investment banking and stable net interest margins. Industrials are riding a wave of domestic infrastructure spending, and utilities are experiencing an unprecedented demand shock due to the massive power requirements of new artificial intelligence data centers. However, we have to look at the math soberly. If the top 5 mega-cap tech stocks, which make up nearly 30% of the index, experience even a modest 10% pullback due to valuation fatigue, the remaining 80% of the market has to do an extraordinary amount of heavy lifting just to keep the index flat. Specifically, mid-caps and value stocks would need to grow their earnings at a rate of nearly 15% over the next year to offset that tech drag. That is a very high bar to clear in a mature economic cycle, especially when manufacturing surveys are still showing signs of contraction. This structural divergence brings us to the core of the debate over Evercore's bull case target of 9,000. Wapner asked the strategists to define the exact path to this extreme 9,000 scenario. They explained that for the S&P 500 to reach 9,000 by next year, two things must happen simultaneously. First, the productivity gains from artificial intelligence must transition from a speculative investment phase into actual corporate balance sheet savings across non-tech sectors. We are talking about insurance companies, banks, and healthcare providers using AI to slash operating expenses and expand their operating margins. Second, the global economy must experience a synchronized recovery, boosting multinational corporate revenues. I find this scenario highly optimistic but not entirely impossible. The speed at which enterprises are adopting generative technology is faster than any software cycle we have seen in decades. If we start seeing real operating margin expansion in traditional sectors, then a 24 times forward multiple on higher earnings is suddenly justifiable. But let us be honest, that is a best-case scenario where absolutely everything goes right. It assumes no geopolitical shocks, no credit events in commercial real estate, and a smooth landing for the global economy. It is a target built on perfection, and in the real world, perfection is a rare commodity. Wapner then raised a critical question about the timeline of these institutional forecasts. He asked if these aggressive targets are inadvertently setting up retail investors for disappointment by making them believe the market will only go up from here. The analysts on the panel made a very important distinction that every investor needs to hear. They emphasized that a target of 8,000 or 9,000 is an eventual destination, not a straight line. They noted that even within the strongest historical bull markets, 10 to 15% corrections are not only common, but they are also a healthy part of the cycle. These pullbacks shake out excess speculation, reset valuations, and allow long-term investors to build larger positions at better prices. The real danger, they argued, is not a temporary market decline, but the opportunity cost of sitting on the sidelines in cash while the long-term compounding power of corporate earnings marches onward. My view is that Wall Street institutions are playing a specific game. They publish these massive targets to capture headlines and build momentum, but they always leave themselves an escape hatch in the fine print. As individual investors, our job is not to blindly buy into these big numbers, but to understand the underlying mechanics that could actually get us there. The technical clearing of hedge fund positioning we saw earlier gives us a solid short-term cushion. The resilient corporate margins provide a decent medium-term floor. But the long-term upside depends entirely on whether those projected earnings actually materialize on the bottom line. We cannot rely on multiple expansion alone to carry us to 8,000. The market is already expensive, and the margin of error is razor thin. If you are going to put capital to work here, you need to be highly selective, focusing on companies with fortress balance sheets and genuine pricing power rather than just riding the index momentum. This debate on CNBC highlighted a profound truth about the current market environment. The line between a massive technical breakout and a severe valuation check has never been finer. While the clearing of institutional leverage suggests the path of least resistance remains upward for now, the incoming inflation data and corporate earnings reports will quickly reveal if those lofty targets are grounded in fundamental reality or are simply Wall Street's latest marketing campaign. The real test will be whether the broader market can successfully pick up the torch from megacap tech as we head into the next seasonal cycle, or if the weight of high interest rates will finally catch up to this economy. Thanks for watching. If you got something out of it, like the video and subscribe to the channel, and I'll see you in the next one.